Hello and welcome to this Luna Investment Management Economic and Market Update. My name is Alex Brandreth. I'm the Chief Investment Officer at Luna Investment Management. Today is going to be quite a quick update and just give you an overview of recent COVID developments in the UK, how the vaccination rollout is progressing. Importantly to us, when we're looking to invest, it's, well, what's the economic impact and when a certain sector is going to be able to open up, and clearly now we have more information on that following on from the Prime Minister's rollout plan. And then we'll also look at how different markets have performed in this environment. We're just going to focus on two today, so we'll go through that. So let's start off with COVID in the UK. This is just a chart which shows the number of daily positive cases. It goes all the way back to over a year ago now, in January 2020. And clearly back then, we weren't having as much mass testing as we are now. So it's not really comparable to look back then from daily positive cases. But you can see more recently, to the end of February, the beginning of March, that the number of cases has fallen significantly. The peak was in early January, and we've fallen to a very great degree over the course of the last 2 months or so. Why is that the case? That's because of the restrictions. Clearly, we've been in lockdown since the beginning of January, but it's also in part due to the vaccination rollout in the UK, as we'll talk on that later. It's clearly very positive news for reopening the economy, for us returning back to our normal life, which will be positive over the coming months. Wow, I mean, I think the only thing we can say about the vaccination rollout in the UK is it's been excellent. There's probably a lot of things that we could criticise over the course of the last year or so. But one thing you definitely can't criticise is the vaccination programme within the UK. We were ordered more per capita than any other country of the different vaccines. Clearly, the AstraZeneca one was more than any other one because of where it was manufactured and developed. But also the fabulous NHS been able to roll this out so widely, so quickly, and the numbers behind it are quite staggering. You can see that within less than 2 months, 20 million people in the UK have received their first vaccine, and that's averaging around 350,000 per day. Tends to be a bit of a peak at the weekend, and some days are a bit lower than that. So the numbers are quite significant. And now the work has started on the second dose as well. There's just under 1 million people that have received their second dose. And over the course of the next few months, and by the end of July, it's looking very likely that the majority of adults, if they want to have a vaccine, will be vaccinated, which is fantastic, and clearly a key strategy in life returning back to normality. And this was one of the reasons why the Prime Minister said what he did in his recent address on the 22nd of February, that the UK can start to get back to normality over the course of the next 4 months or so until mid-June, when there'll be potentially no restrictions. I say potentially because we still need to watch the numbers and the stats to see if that is a realistic target or not. But that is very important because life returning back to normality is going to have a very significant impact on the economy. And this is UK economic growth going all the way back to the 1950s. And you can see that we're in this very boring range in hindsight of kind of -2% to +5%. And that was always the way that UK GDP had been on a quarterly basis. And then COVID hit, and you can see that it impacted the economy a bit like a heart monitor. The economy fell by nearly 20% in the period between April and July last year in the second quarter. But as restrictions were eased into the summer last year, you can see how quickly and sharply the economy bounced back to a positive number of 16%. And then in the final quarter of last year, when restrictions were imposed on us again, then the economy grew still at 1%, but nowhere near the 16% growth in the third quarter. Why is this important? I think this is a very good roadmap to see the impact that we're going to have through 2021. The first quarter, the quarter we're in now until the end of March, is likely to be probably not as negative as it was in the second quarter of last year, at kind of -20%, but it's going to be a big negative number. It's going to be a big negative number because the lockdown and the restrictions are long. They're very similar to the period that we had in the second quarter of last year. So it's going to be a significantly negative period for the overall economy. But that's behind us, or almost behind us now. We're now starting to look through that into the economy reopening. And you can see what happens when the economy did partially reopen in the third quarter last year. And that's what we're expecting to see over the course of the next 9 months through 2021 from the end of March. Economic conditions are going to gradually get better. Individuals have very strong savings. There's significant pent-up demand. After a year of certain restrictions being placed upon our lives, people are keen to go on holiday. People are keen to go to the pub. People are keen to get back to normality, get back to the office. And that is going to have a significant impact on economic growth. Now, that's going to be felt through the second half of this year, and that's what we said in the economic outlook at the beginning of the year. But there's also going to be some spillover to next year as well. Some people might not feel comfortable going on holiday this year. They might delay that decision till next year. Either way, we're going to see very strong figures towards the end of this year. And that backdrop is very positive for risk assets and equities particularly. On this chart, we just take a look at what's happened over the last 4 months or so. So this looks at the FTSE 100 in the dark blue line, and it's got the Barclays Gilt Index, Bloomberg Barclays Gilt Index in the lunar yellow line there. We've taken this back to the beginning of November to highlight the impact that vaccines have had on risk assets and also kind of safe haven assets like government bonds. Equity markets have performed very strongly over the last 4 months or so, increasing by 17.3% over this very short time period, whereas bonds and traditional safe havens have actually fallen in value. And what's been very interesting is that it's been really the last month or so. February has been a very weak period for government bonds. And we spend a lot of time discussing equity markets, and people are always interested about what's going on in the equity market. But in February, it's actually the bond market which has been getting more headlines. And what's been happening in the bond markets is bond yields have been increasing. Bond yields have been increasing because investors have been selling those assets. Investors have been selling those assets because they are feeling more optimistic about the environment. On top of that, over the last few years, or last 30 years, bonds have been a one-way bet. They've gradually fallen in yield, and that's meant their prices increased in value. So it got to the end of, and during the pandemic, to push them to all-time record low levels. And for us and for other investors, we're looking there and thinking, well, these have done fantastically well, but looking forward, are they going to be able to deliver similar type returns? And the answer is mathematically that's practically impossible to do. So we actually reduced our bond allocation around the vaccine news back in November. We increased equities at the same time. And that was on the back of, we could see global growth picking up, we could see inflation picking up, and that tends to be a negative environment for bonds. When inflation particularly was very high in the 1970s, interest rates had to be high to combat that, which meant that bond yields were at very high levels. Today, interest rates are at very low levels and inflation's at very low levels. So there's been a complete sea change over the last 40 or so years. So where we are today, bond yields have now started to fall in value. That to us is expected because it's a healthy sign that the global economic recovery is coming through. It suggests that inflation is coming through. No, you have to remember a year ago we had a negative oil price, so it's expected when you're looking on an annual basis that inflation will rise. And it's also a positive because you're potentially seeing companies having some pricing power and increasing their prices. And that's the environment that we think we're going to be in over the course of this year. So that's why bonds have been selling off. That did actually spook equities towards the end of February. And one of the reasons for that is that companies price their debt off government bond yields, and as government bond yields are going higher, that also means that corporate bond yields are moving higher. So corporates are going to have to spend more to refinance their debt than they have been over the course of the last year or so. So that hits certain sectors as well, particularly very hard. Technology, which has performed very strongly throughout the course of 2020, the great enabler, has come under a little bit of pressure in the short term. Again, we did rotate some holdings away from technology last year. So where are we looking forward? The economy is reopening. Certain companies and sectors, through no fault of their own, have been hugely impacted by the pandemic, are going to have a very good shot in the arm, like a jab, over the course of the next year or so. Travel and leisure is probably, particularly in hospitality, is the perfect example of that, where these companies have now started to do very well, and we think these profitability, these businesses continuing to improve over the course of this year. We'll still be using technology. We just think that technology probably isn't as attractive today as it was a year or so ago, in hindsight. So we have rotated some of our technology exposure away to more cyclical areas that can perform better as the economy reopens. So that's a quick summary for myself. Restrictions and vaccinations are bringing down a number of COVID cases, which is a clear positive for all of us. It's a clear positive for the economy and investing as well. As that comes through, restrictions will continue to be gradually eased. The roadmap already highlights that very well, which will have a significant positive impact on the economy. We've already had a test case for this in the second quarter and the third quarter of last year, so we can see how quickly the economy can bounce back. I didn't mention it earlier, but individuals have been paying down debt and have high savings ratios. So as soon as we can, and we can get back to normality, then we will get back to normality, and we'll go out and spend that capital. EasyJet, straight after the Prime Minister's announced one of their busiest days ever. I think it was 4 times higher, the amount of people booking holidays than the previous week. So it gives you an idea that there is significant pent-up demand there. And yes, it's been great news for equity investors because as the economy reopens, that's better for certain companies. However, unsurprisingly, it's not been a good environment for traditional safe haven assets like government bonds, which have come under pressure. That's all from me. Thank you for listening today. Stay well and healthy, and look forward to seeing you all again soon. Bye now.